Imagine waking up, checking your phone, and seeing a $500 cash deposit hit your bank account from companies like Apple, Coca-Cola, or Home Depot. You didn't clock in, you didn't sell anything, and you didn't work a single hour for it. Dividend investing is the primary mechanism the wealthiest families have used for generations to maintain their riches. Today, we are going to calculate the precise portfolio size you need to pay your bills, select a safe asset to reach that target, and physically turn on the automated wealth engine inside your account. To follow along, you need 3 things: your monthly living expenses, a basic calculator, and an open brokerage account. Building this requires moving past the idea of quick wins and focusing on the mathematical reality of covering your expenses. Step 1 is understanding the asset. When a company makes a profit, they can either reinvest it into their business or give a cut of those profits directly back to the owners, the shareholders. That cash payment is a dividend. To figure out how much cash flow you need to survive, we use a formula to find your freedom number. Start by calculating your baseline monthly living expenses. This equation shows exactly how to calculate it using the 4% rule. Let's say your living expenses are $4,000 a month. Multiply that by 12 to get $48,000 a year. If a healthy dividend portfolio yields a safe 4% a year, divide that $48,000 by 0.04. The math gives us a final requirement of $1.2 million invested to generate that $4,000 a month, completely passively. I am brutally honest with you about the math, because you can't live off dividends with just a few $1,000s. Seeing a massive 7-figure requirement causes many beginners to panic and abandon the strategy entirely. Rome wasn't built in a day. Instead of looking at the $1 million finish line, target your first micro milestone. Build a portfolio that generates $15 a month to cover your Netflix subscription. Then target your $80 phone bill. Then pay for your groceries, and eventually cover your rent. Breaking an intimidating multi-million-dollar goal down to a single utility bill removes the friction. It turns wealth building into an actionable daily habit. With a target set, we have to pick the assets. New investors constantly fail here by sorting stocks by the highest dividend yield and blindly buying whatever is at the top. This chart shows exactly why that is a massive mistake. On the left is an ultra-high yield of 15%. According to Investopedia, this is a major red flag, indicating that the company is failing, the stock price is crashing, and the dividend is about to be cut. Instead, look at the right side of the chart. This represents a safe, steady upward trend, hitting our 4% target. To find that safety, look for Dividend Aristocrats. A Dividend Aristocrat is a company that has increased its dividend payout every year for 25 years or more, like Target or Johnson & Johnson. If you want to eliminate the risk of picking individual stocks entirely, you can buy dividend ETFs, like SCHD or VYM. An ETF, or exchange-traded fund, simply bundles the best dividend-paying companies together into a single asset. Consistency and capital preservation are the true wealth generators. Chasing after a high-yield illusion will rapidly drain your account. Step 3 is setting up the DRIP, which stands for Dividend Reinvestment Plan. While you are working your day job, letting your dividend cash sit idle in your brokerage account ruins your momentum. Log into your brokerage account right now and navigate to your individual dividend settings. This image shows a standard brokerage interface. Click the Positions tab, locate Dividend Management, and check the option to Reinvest in Security. You can verify the setup by checking your holdings. Look for a status indicator labeled Reinvesting next to your stock symbols. With the DRIP active, execute your first trade today. Take whatever cash you have available and buy one single share of the SAFE ETF. By checking this single reinvestment box, you upgrade your financial trajectory from static saving to active exponential compounding. This is the snowball effect in action. Because of the DRIP, next quarter's passive income automatically buys new shares. Those new shares then pay you even more dividends, which buy even more shares. With this system in place, you have transitioned from being a consumer to becoming an owner of cash-flowing assets. Your immediate marching orders are simple. Fund your account just enough this month to eliminate that first micro-milestone bill. If you want to know which specific dividend ETFs I am buying this year to build my snowball, click this video on the screen right now.